Welcome to TMS Insights. It's November and it's Ben Clark and Jeremy Hook bring you some updates of what's been going on in the market. And since we last presented the insights, there's certainly been a fair amount of price action. The September quarter was okay, but October was a down month. And we've seen some real changes in our market. A number of those are offshore factors and then in many cases stock specific. But Ben, I guess the first real wave of probably selling, I guess, has been related to the change in interest rate assumptions.
Yeah.
And that in turn hit a very well-performed part of our market over the last few years, the yield stocks.
Yep, that's definitely right. Last Wednesday we saw some reasonable inflation data. It wasn't, you wouldn't say it was glowing, but it was certainly better than the last print. And the market, I think, quickly sort of factored in that we might have seen at the last of the interest rate cuts in this cycle, and B, there's been quite a large move higher in longer dated bonds in Australia. So the market is starting to price in the expectation of higher rates in the future, probably not the next year or two, but at some stage in the future. And of course that has a couple of implications for our share market. The first is potentially the yields that are on offer are not quite as attractive as what you can get in the bond market now, and therefore we've seen a sell-off in, big sell-off in property trusts. Has been an area, infrastructure.
That's right, infrastructure, which have become a very well-performed place in the market. If you look at the airports and the toll road operators, they've done very well, but sold off quite sharply over the last 2 months.
Absolutely.
And so that really was, probably what brought the market from that, say, 5,600 level almost back into the 5,300 area. But the other one is really what then happened in growth stocks. And it'd be fair to say that, in a broad sense, there's been a move of money out of well-performed growth stocks, higher PE kind of stocks, with earnings growth above the market, into stocks which would more traditionally be regarded as value plays.
Absolutely. Yeah, and we can see this front and centre right across the spectrum of what we would say the higher quality businesses on our market. There's been a 15 to 20% pullback in many cases, with zero news from the company and zero sort of change in the outlooks or the underlying fundamentals. And it just looks like there's a rotation of money happening at the moment, into resources and as you said, the more value areas. So lower growth companies that have been really beaten up over the last few years that arguably look cheap, and to fund that has come money out of those stronger performing businesses over the last 5 years. And we
might actually get into the names of some of those in just a moment. But look, we'll bring up that chart that we want to talk about just to put in context of where it actually looks, this kind of pullback that we've seen. And the chart shows that the pullback, which is around about 5%, from the more recent peak, is consistent with a number of other pullbacks that we've seen in this year alone.
Yeah.
And I think the big one was in January, but there's been about 3 since throughout the year, Ben.
Yeah, and I would say, just sort of speaking to clients, a 5 to 7% correction in the overall share market, I guess we would say it's never fun when you're going through it, but it's going to happen reasonably regularly. Yeah. And you can see in this chart that I think this is the 5th correction of that sort of magnitude we've had this calendar year. And that's probably not that unusual. No. We're certainly not in a terrible market at the moment, but we're not in a great market either. You'll normally see in more of a bull sort of market, shorter, sharper corrections, sort of maybe 3 to 5%, and in bear markets, probably a bit worse than what we're seeing at the moment. But I think what it masks is what's happening within the market again, and that's because the banks and the resource stocks are still major components of the index that we just showed there. And when you talk about the market, you're really talking actually about a very small number of companies. But the banks have actually done pretty well.
They've held up, and again,
resources have been good
in this more recent period, definitely.
Yep.
So, and again, that's just that changing leadership in the market, and you can certainly do well if you're able to get in and inside those various sector changes that happen. But through the passage of time, we see that these things smooth out somewhat.
Yep.
Just to focus on some of the stocks that have been of interest, we know there's been AGM season. That's produced a couple of announcements, sometimes like Challenger, where they've effectively given really positive updated news, or the stocks we don't hold, like an AMP, had pretty disastrous news in theirs. But
Yeah.
it is a time. But Ben, looking at some of those growth stocks that have come down a little bit.
Yeah. Look, I think where we're talking about, healthcare really stands out to me, and it's probably the irony of it is that they're really, these businesses are generally very reliable, structural tailwinds, good. Australia really bats above its weight in world-class sort of healthcare stocks. There hasn't been, the only change I could potentially think of is Hillary Clinton has said in the US she will come down hard on some of the drug companies, manufacturers there if she becomes president. Okay. But, sort of CSL, ResMed, Ramsay, et cetera, have all come off about 15%. Yeah. And then, there's the glamour stocks, some we own, some we don't own, REA, right. Domino's Pizza, Aristocrat Leisure. Some have done, all of those have done incredibly well. Yeah. But you look at Domino's as an example, that's now had a 25% pullback over the last few weeks with no change in fundamentals. Yeah. So it just sort of highlights to us that this isn't necessarily a stock-by-stock problem or even a sector problem, because it's happening across all of the sectors. But the theme that's in common is that these are companies that have done really well over the last 4 or 5 years, trade on high PEs, and have good, strong growth outlooks. Yeah, no, excellent. Now let's look forward, because we've got some very big week ahead of Tuesday's US presidential election, which is something that has been concerning markets. There's no doubt that it's rattling markets at the moment, the possibility of a Trump win. Obviously, we're not here to forecast the outcome of the election, but to understand what the metrics might be should the less likely Trump victory worries markets now, and what would it do afterwards? Ben, what do you think? Look, I think trying to work that out is very hard. If you look at the bookies markets at the moment, which we know have been wrong in the past, i.e. Brexit, they're saying there's about a 1 in 3 chance of a Trump victory at the moment. And 22 million Americans apparently have already voted. I suspect if we get a Trump victory, we're going to get a short, sharp period of, a sell-off and a period of concern, which would probably be quite a good buying opportunity, I think. Trump, we all know, has said some things that are pretty concerning, but how much of that actually becomes real, I think, is debatable. And I think this is the main point, is that the US political system isn't controlled entirely by the president, so Congress becomes a very important part of the overall governance and lawmaking process, and a lot of what the heat of an election battle comments that come through, many very rarely get even drafted as bills for looking at Congress, and I think even House Republicans would be very alarmed at any of the Trump proposals. So if he does win, there's still a quite different legislative agenda, I think, that will actually take place under his presidency. So the other thing I'd just add is, because we'll get some clients sort of saying, maybe we should sell and just wait and see how this plays out. The far more likely scenario of Clinton winning, I think, would see a short, sharp rally in global markets on some of the concerns. And a Trump win has already, I think, partially now been priced into markets. So, and then this is the point about events of this kind. They are known, even if we don't know the outcome, that we're going to have a president made on the result of Tuesday's election. So markets do factor these things in. So we'll be watching, we'll be bringing you any updates, but more or less it won't change a lot of our investment approach or the way we do things in terms of selecting stocks, and nor has the recent experience of what is really quite a regular kind of pullback for the market. Well, that's all we've got time for today. We'll bring you another update in a little while. Thank you.